if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100.
What's unfolding in the gold market, according to PeterSchiff of Schiff Gold, is only the opening act of a much bigger story. He argues that the real breakout began in 2024 when gold finally shattered the $2,000 ceiling and quietly pushed toward $3,000, catching much of Wall Street off guard. Instead of recognizing the shift, many analysts downgraded industry leaders like Newmont and Barrick, assuming the run was over. Schiff insists that those calls completely missed the underlying transformation, where gold's strength reflects deep cracks in the financial system rather than just a short-term rally. The core issue, he says, lies in U.S. fiscal and monetary policy, which he calls increasingly reckless. A recent weak jobs report exposed just how fragile the labor market has become, resembling conditions last seen during the 2008 crash or the 2020 shutdown. Despite this, the Federal Reserve continues to talk up labor market strength, even as it prepares to cut rates into an environment already strained by inflation. To Schiff, this is the turning point. Political pressures are now dictating monetary policy, and that shift threatens the credibility of the dollar. When faith in paper money weakens, he argues, gold inevitably steps forward as the asset investors trust most. Another sign of what's brewing comes from the miners. While spot gold prices spent months trading sideways, mining stocks quietly surged 30 to 40%, showing a level of confidence not seen in years. Schiff points out that companies like Newmont have outpaced even some of the strongest tech giants in the S&P 500, putting miners among the year's top performers. Yet this strength remains largely ignored by mainstream investors, who still view gold as a fringe play. For Schiff, that disconnect is the most telling signal of all. The broader market hasn't caught on yet, which means the next phase of this gold cycle may be even more dramatic. Before we dive into Peter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think this cycle really just got started after that consolidation, but I think the leg started in 2024 when we broke above 2,000 and we quietly moved from 2,000 to 3,000 and nobody noticed it. In fact, when gold was hanging out at 2,000, a lot of analysts put sell recommendations on Newmont and Barrick because they thought that gold had topped and they didn't see any upside. And then I think when Trump won, a lot of people expected the gold to fall because the economy was going to boom and Trump was going to do all this great stuff about shrinking the deficit, making America great again. But now it's becoming more obvious that none of that was true. But I think this is a new leg. We spent really over 10 years. Remember, the first leg of the bull market was 2001 to 2011. Gold went from under 300 to 1,900. So it increased by sixfold, right? Then it really went sideways from 2011 to 2024. Gold traded between 2,000 and maybe 1,500, 1,700. I mean, it initially pulled back to 1,000. It got to 1,050 in 2015. So it held 1,000, went back up, but only made a new high briefly during the 2020 COVID crisis. It poked its head above 2,000, but then, it got chopped off and it went back down. But that's a huge base that we built around 2,000 as a floor now, because it was resistance. It was the ceiling. Now it's the support. And now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1,900 consolidation. That was a sixfold increase. If you assume we go up sixfold from 2,000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. And I think that there's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. And in fact, following the weak jobs report that we got today. And by the way, the jobs market has never been this weak outside of a recession. In fact, the last two times you had a labor market as weak as the one we got right now, it was the Great Recession of 2008, 2009 with the financial crisis, or 2020 as we were shutting the whole economy down because of COVID. So, the Fed has been mischaracterizing this labor market. Powell kept saying we have a really strong labor market. We have a really strong market. He was wrong the entire time. We have a weak labor market. And you would even see how much weaker it was if we had honest statistics. But we don't. But even with the statistics we have, we had outright job decline in June. We lost 13,000 jobs in June. The August number was just plus 22,000. Manufacturing lost 13,000. And the U6 unemployment rate, which is more relevant than the headline rate of 4.3, is 8.1. So we've got rising unemployment and inflation. The Fed said that the labor market was strong, but inflation is weak. They got it backwards. The labor market is weak. Inflation is strong. And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad and we got a long way to go. But, the whole time that gold was going sideways for 3 or 4 months, gold stocks went up 30-40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices, but at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them. I think Newmont Mining is the number one performing stock in the S&P 500. The only gold stock in the S&P 500, and it's beating all the tech stocks. Yet probably of all the stocks in the S&P 500, Newmont is probably the one that's the least owned.
PeterSchiff emphasizes that if gold were to rise toward $10,000 and silver toward $200, the gold-to-silver ratio would contract to around 50-1, a level consistent with historic norms and one that underscores silver's underappreciated potential. Gold has already broken decisively out of its lengthy consolidation, but silver still faces a formidable ceiling at $50, a resistance point tested twice before, during the 1980 surge and again in 2011. Schiff argues that this barrier is more than psychological. It represents decades of market memory. Once silver breaks through it, the metal would enter uncharted territory, where sentiment and momentum could shift dramatically in its favor. According to Schiff, the key lies in silver transforming $50 from a ceiling into a floor. If that breakout occurs convincingly, the path higher could unfold at remarkable speed. Rather than a slow, drawn-out climb, the move to $100 could happen in a matter of months because the technical resistance above $50 is minimal. This kind of setup creates the conditions for an explosive rally, one that investors often underestimate until it is well underway. Schiff suggests that this dynamic places silver at the edge of a rare and powerful turning point, where its performance could outpace even gold in the next phase of the precious metals cycle.
If you have $10,000 gold, $200 silver, what is that, 50-1? That's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50 because we have a double top there. That goes back to 1980, and then again we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months. right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist. I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin. All the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be.
The structure of the silver market itself adds fuel to this potential. Heavy short positions have long weighed on prices, but a breakout would force short covering, creating a rush of buying that amplifies the rally. At the same time, physical supply constraints would intensify the scramble for ounces, further tightening the market. Schiff describes silver as one of the most tightly wound opportunities available today. Its breakout has been delayed, but not denied. With gold already surging and mining stocks quietly outperforming some of the market's most celebrated sectors, the stage is set for a shift that could redefine how investors view both assets and the monetary system they hedge against. The pressing question, he argues, is whether investors will recognize this turning point as it happens, or only realize its magnitude once the opportunity has already slipped away. That's it for today. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.